What up? It's your boy Jay Snipes. It's Notebooks to Notes, and I'm back with another video. And today I'm going to be breaking down how the market educational system has been lying to you this whole time about support and resistance, and how you can use support and resistance in conjunction with supply and demand to make better and more profitable trades. But before all that, I'm going to need you guys to click and smash that subscribe button, as it helps grow our community and it helps trick the algorithm on pushing my content to more people that may find my videos useful to them. But now that you're done with all that, let me break down this video. So for those that don't understand, or for those that may be new to trading, that don't understand what what support and resistance is, let me break it down to you. So say prices are at 230, they drop down to 225, go up to 230 again, drop down to 225, go back up to 230, then drop down to 225 again. It's fair to say that 225 is now the floor and 230 is now the ceiling. This is what you would refer to as support and resistance. The support being 225, as the buyers have now enough passive orders in the market to now absorb any aggressive selling or any passive sell orders to now level that price, and now not allow prices to trickle down to the next level. And it's fair to say that 230 has now become our ceiling, and that there's enough sell orders or enough passive sell orders to absorb any aggressive buying to not allow prices to move past that price level. This is what we would refer to as support and resistance. These are our support and resistance levels. And this is what we're taught. So fair to say you would buy at 225 because you know that there's enough buyers there to push prices higher and there's no more sell interest, correct? And fair to say that you would sell at 230 because there's no more buyers in the market and there's enough sell orders to push prices lower. This is the retail concepts that we've been taught. And the same retail concepts that make us lose over and over and over again. It's a countless amount of times that I've tried to test and back test these strategies live in the markets and have realized that majority of the time I'm either too late or the move already happened. Right? I guess it's the same thing. But it goes to show you that one, either this doesn't work, or two, I'm just horrible at trading. Well, I'm here to tell you it could be both. Or it could just be the fact that support and resistance does not work the way you want it to or the way that it's been taught to. And what I mean by that is the banks don't use that. You have to understand that we are retail traders and we get retail educational systems. So we're learning retail strategies. There's retail and there's institutional. The institutions, like the banks, these are the banks. They make up for 80% of the market volume. They're the ones that are moving the markets. So they do not rely on retail concepts. And they know that that's what we rely on. So they create scenarios so we spot opportunities to now place trades based on the concepts that we've been taught. And this is where we end up on the wrong end of the trade. So understanding where their key levels are and where they place orders will help you become a profitable trader. They can't just place orders because they're just so big and they have millions and millions of orders. So them placing, a whole buy order would just move the markets too much. So they have to do it in increments. So at 230, they'll buy. At 228, they'll buy. At 225, they'll buy. You know what I mean? They'll push the markets lower So as you're selling into the markets, they're realistically selling you their shares. Because remember what I said in the last video, for every buyer there's a seller, for every seller there's a buyer. So as they're tanking the markets, they're giving you what they have. They're exiting their positions to buy the market, to push the market higher. So understanding where their key levels are and understanding where they may place orders will put you 10 steps ahead of the game. Let me break that down to you in this video. I don't want to take up too much of your time. I know the last couple of videos have been like 20 something minutes. I don't want to have you guys sit here like that again. But I'm gonna try to break this down to you as clearly as possible, where you guys can come out of this and understand where the banks may keep their levels and where the banks trade. So as you can see, I got Tesla over here. And I have these two zones. Everything in here is an operating range, and that is eternal liquidity. So I'm gonna go down to the 1 hour, and then I'll break everything down later. So we're here on the 1 hour, and I got my I got my supply and demand zone. I got my demand, I got my supply. And the reason why this is a supply zone is because it's a key level that the banks have used in the past. As you could see, every time prices have moved to this level, they immediately get rejected and bought out, and immediately break structure and move to the next high. As you can see, it did it here. The buyers came in, bought offers at a higher price, broke structure again. Didn't break structure here, mitigated orders down here because it's a key level. There's orders that have been left from the original pump. There's orders that are left here. So there's buy orders that are left here. This is why this is a key level as well. Understand that there's going to be a lot of buy orders, passive buy orders under here, and a lot of passive buy orders that weren't mitigated on this first run up. So understand that when it comes down here, this is a key level. So this can also be considered resistance. And this is where it becomes subjective at times. But on a higher time frame, you're looking at a higher time frame, you're looking at swing lows, swing highs, you can consider this as a demand zone. So as you can see, there's going to be some passive orders behind here or under here, and this is what was able to shoot prices up in the break of structure, in the break of this high. And it did it again until eventually it could not break anymore, and it eventually broke past that and made its next leg down, and created some sort of level over here, a level between 233 and 240. So as you can see, we have our first key level here, and now our demand is now flipping over to supply, because now any sell order is now passively waiting above this line. Because remember, the aggressive sell orders were able to push past this and break past this zone where there was passive buy orders. Those aggressive sell orders were now able to absorb those passive buy orders and now create a new zone. So now the bias has flipped. Now you could start looking for sell entries, because a major key level has been broken, and it's been tested and reacted against. And now that reaction is being rejected. So it tells you something. It tells you that the banks have now exited positions. They are looking to move prices lower. Like I mentioned in the last video, you're always going to get a break and retest, and you did. You got that break and retest, and it tried, but there was enough passive sell orders in the market where eventually the buyers gave up and became non-reactive, and it made that next leg lower. So if you go in on the 15 and on the 5 minute, it gives you a better story on what happened. As you can see, it was within a zone of that shelf. Is that supply and demand zone. This is not demand, this is support and resistance, but this is internal liquidity now that we're on the 5 minute. So you have external and internal. External, you're looking at the 4 hour, the daily, and you're looking at the swing lows and the swing highs. That's external liquidity. When you scale down to the 15 minute, 5 minute, and the 1 minute, you're not looking at internal liquidity. You're not looking at an operating range. How is the operating range, and understanding what the operating range is doing, price action, volume, etc. You can understand, okay, where is it going in conjunction to the external liquidity? Is it going to reach that swing high, or is it going to reach that swing low? That's why I love scaling down on the time frame, 5 minute, 1 minute, 15 minutes, because it gives you a better story and a better insight on how the market is moving and how the markets may get your directional bias. So as you can see here, Once it was in that shelf, it started kind of consolidating near the demand zone. And then, as you can see, the price sellers started to lower the bid, and lower the offer. And as you can see, as they were lowering the offer, prices were getting rejected, and eventually broke that zone. And from there, it tried to retest that zone and grab any leftover orders. And once it grabbed any leftover orders that were in that zone, it eventually shot down, right? So this is where supply and demand come into play, because now we're going to head back to the 1 hour, or actually go to the 4 hour. And this is where external liquidity comes into play. So as you can see here, like I mentioned before, all of this is a key level. So the next key level you're looking for, because banks trade from supply to demand, Just like we trade from support to resistance, they trade supply to demand. So now you're going to be looking for the next key level, the next demand level, because now supply, the last demand level has now flipped over to supply and is now reacting as supply and is now not letting any buyers break that price level. So now you have to look for the next demand zone, the key level, to mitigate orders, because prices will now have to mitigate orders to now create liquidity to bring prices to wherever they need the prices to go. Like I mentioned in the last video, prices, the market moves on liquidity. The banks create liquidity by pumping the markets and you buying into their positions so they can sell out of their positions. Like I mentioned before, it's 80% of the volume in the market. They can't just exit and enter positions. So what they'll do is they'll dump the market while you are selling. They're essentially buying the market. And this is why you'll see a rally at a key level, at a bottom or a base, because there was a whole bunch of passive institutional orders there already, and they were just selling so you guys can create liquidity to get further down to that level to mitigate their orders, because they couldn't have mitigated those orders on their own. It would have just been a one-side game, right? So this is what they're doing when they're dumping or pumping the markets. They're either buying their position or they're selling their positions. And in this case, they were selling their positions. So as they were selling the market, you could have been buying in. But as you can see, we're going to go down here. And this is where you got to kind of do your analysis and your due diligence. You got to find out where other key levels were. Where are the banks trading? And I marked this zone right here. This is a reaction zone. As you can see, 1, 2, 3, 4. 4 times that this zone was rejected. So there was a whole bunch of passive sell orders in this zone right here, right? Eventually, the passive sell orders became non-reactive, and the buyers started to inject orders into the market and were able to absorb these sell orders. So the next way around, once it had that liquidity pull and mitigated as many orders as possible, it was able to have enough strength to now burst past this zone and now continue that uptrend. This is what you like to see. This is what you call a key level. As you can see, it reacted to this level multiple times, and it eventually absorbed all sell orders. So the next time it tried to get to this level, there wasn't any selling left. There was only buy orders left. So you can mark this as a key level. So you can frame this as a magnet zone, because the prices more times than not are going to hit these key levels to mitigate orders, right? They're like magnet zones. Okay. So as you can see, it broke that structure. Let's bring that back. As you can see, it consolidated within this zone. So it could have done anything here. This is where you have to be patient. Like I said, I like to wait for a retest, and then price action will kind of tell me what's going on. So you're on the 4 hour right now. The 4 hour shows you that the buyers tried to step in and it got immediately rejected once they got into that supply zone, right? And as you can see, we break down to the 1 hour. As you can see, the sellers are coming in. They're stepping in, and the buyers are trying to buy again. This is now, since we're on the 1 hour, 15 minutes from the 4 hour. You can consider this a support zone, right? So now that you can consider this a support zone, you can kind of see, okay, this is where you can kind of mess up, because now you're going to be looking to buy, right? But also remember that there's a lot of passive sell orders here. So there could be sellers coming in aggressively before it hits this price area to be pushing prices lower to the next leg down, right? And this is where that concept of support and resistance can be very, very subjective, because you don't know. There could be multiple support and resistances depending on the time frame and depending on the market conditions. There could be, a multitude of support and resistances. So you really got to really pay attention to key levels and banks' key levels and understanding where liquidity and orders are in the market. So as you can see here, you would have bought here thinking the price was going to go up because you saw a few blue candles or green candles. And what did prices do? Prices, they got rejected. So the sellers, they were now willing and actively selling at a lower price, and now buyers becoming non-reactive. Buyers were interested at these price levels. So you have to use price action and patience to understand what's going on in the market. And if you see on the 15-minute, if you look at the price action, you could see that once it dropped into this support zone, that it could not break out of the support zone. So it tells you that more aggressive sellers are coming into this market and they're now trying to push prices lower. Even though buyers are still trying to come in, like right here, you can see buyers still trying to come in. The wicks tell you everything you need to know. Everything you need to know. Right here, look at buyers try to come in, rejected, and then a nice engulfing candle. It could have been engulfing if it was a little higher up, but I'm just going to consider that an engulfing candle. It is what it is. But nice volume to the downside. The buyers tried to step in twice and got rejected both times. And what did it do? It pushed down lower. So you got to use price action to kind of give you a better story. And then you got to scale down to the lower time frames to kind of see what's going on. If you went down to the 5-minute, you could see how many times it's been rejected in this zone. And then eventually it just broke this zone. So it created it created another zone. And that's why I said it could be very, very subjective depending on, the time frame that you're on, because as you can see, it created another support zone. And now you could have been buying in. Probably not smart because it didn't move much, probably a few cents, less than $1. But as you can see, it created another zone, and the sellers stepped in and were able to mitigate prices to the next level, which is the lower level. As you can see, this is how the market moves. This is how the banks move the markets based on supply and demand, and how they move the markets based on orders. So you have to understand different methods of, price action, volume spread analysis and stuff like that. Level 2, definite market. Use those in conjunction with key levels, and I'm telling you, it will change the way you think. You also have to have your critical thinking skills very, very sharpened, because you have to understand that, yes, you may have a buy bias, but it can turn into a sell bias as soon as you enter that trade. So you have to be open. You have to be open to all concepts in the market. You can't just think one way and see things one way. You have to see, okay, you enter a buy position, see why this buy position cannot work out. You have to see both ways to have an understanding to be able to adjust. Once you're able to adjust, you'll be able to maneuver in the markets as such. And you'll basically be able to move like the banks, literally. So that's all for today. I hope you guys enjoyed this video. If you guys can like and hit that subscribe button, that would be greatly appreciated. Like I mentioned, it helps this community grow. And if you guys have any questions or any topics that I may have missed, or something that I may went over incorrectly, please drop it in the comment section below. I love to hear your guys' insights, and I love to hear your feedback. If you guys have any topics that you guys want me to cover on the next video, please drop that in the comment section below, as I'm looking for new topics to cover to help new traders become profitable traders. But yeah, man, I hope you guys enjoyed the video. I hope you guys can take some useful, insightful information for this video and add it to your own trading strategy. But until next time, this is Jay Snipes, Notebooks to Notes. Until next time, I'll see you guys later. I'm Audi 5000. Peace.